Welcome to CMR Interviews by Jason Shapiro. In today's episode, Jason Shapiro interviews Simon Ree on trading success, trend following, and trading options. To learn more about Jason and Simon, check the episode notes in the description.
All right, hello. Today is December 6th, 2023. I'm Jason Shapiro with crowdedmarketreport.com. Today, I have joining me, fortunately, Simon Ree, who is somebody who wrote a book named The Tao of Trading quite a while ago. I read that a few years ago, actually. And he just always comes across my feeds, and I always like the things he has to say, which is why I asked him to speak with us, because I think he has some very relevant ideas about markets and about how markets work. And I think he is in agreement with me that 99% of this is here, more than on the screens. So a lot of times I like to bring in people who have different views than me. In this case, I think we're going to find somebody that has some similar views than I do about markets, although his approach to markets is somewhat different than mine. So I think we can see that again. While we are both focused on the bigger picture of what's important, we approach it in a different way. So I think that could be interesting. So with that being said, Simon, welcome and thanks for joining us.
Thanks very much, Jason. And yeah, I see you on my feed every day as well. And I love your approach to markets and the way you share your insight in a very, very direct, no bullshit approach. I think it's refreshing.
Thanks. No room for bullshit in this game, right?
Right. Although there's plenty of it out there.
There is plenty of it out there. It's a fact. So tell us, what are we doing wrong? How are we approaching markets wrong from your point of view? And how can we get better at it? Why don't we start with that?
I think people overcomplicate the whole process of analyzing markets, whether it's technical analysis, whether it's fundamental analysis, whether it's, sentiment analysis, whether it's quantitative, or whatever your approach is, or combination of approaches, whether it's macro. I think it's really important for people to bear in mind that the price of any asset in any market, whether it's a stock, a barrel of oil, or a bunch of bananas at the fruit and veg market, is determined by supply and demand. All right, so that is what determines price. People will argue that price is driven by fundamentals. Fundamentals only affect price in as much as they affect supply and demand. All right, so I think that's something that people can lose sight of. What I like about technical analysis, why I take a technical approach to markets, is because when you get into it and you practice it, you can really imagine the pain or the euphoria or the FOMO that other market participants are experiencing when certain setups develop. One of the setups I love to look for are, false breakouts and false breakdowns, because you can see where longs are trapped or shorts are trapped, and there's either going to be stop losses getting hit or there's going to be short covering when they fail. And that's one very easy example of where technical analysis can really highlight the pain that other traders are in and what their most likely response is going to be. And if there's going to be a sudden flood of aggressive new marginal buyers or sellers, all other things being equal, it's going to impact price. Now, it doesn't work out every time, which is why we're always dealing with probabilities, but it can work out most of the time.
Yeah, I would say as well, fundamentals affect markets only as they're going to affect supply demand. And to me, my big thing is only as those fundamentals are not discounted in is the thing for me, right? Like the fundamentals one thing, but if it's already discounted in, then there's no value in trying to make money off of that fundamental, to me, right?
If everybody knows about it, yeah.
Yeah, I think that the market clearly is a discounting mechanism, and I think that's what people forget.
You know what? I think it depends on the market. Like people say that about the stock market, and I reckon that was absolutely true 30 years ago. You know, during the Peter Lynch era, when markets were dominated by stock pickers and people who were performing DCF analyses and really trying to forecast future cash flows and value companies. I reckon these days the market is so dominated by mechanical passive flows at one extreme and zero DTE traders at the other. The stock market has lost a lot of that discounting ability. I think it's become way more reactive than it ever used to be.
Interesting take.
And I know you focus kind of more heavily on commodity markets. I think that they probably are better discounting mechanisms because, you know, supply and demand is such an important driver in commodities, right?
Yes. I mean, I do trade the financial markets just as much, the stock indices or the fixed income markets or stuff like that. I approach them all the same way.
Right.
But I hear what you're saying. Certainly corn doesn't have the 1 day, what do they call it? ODTE thing or whatever.
The zero data expiration options. Yeah.
Yeah, probably also doesn't have anywhere near as much day traders going on as you do in the S&P. That's for sure. So the point taken, the stock market is somewhat different in that way than I hope, I like to believe that for my purposes it doesn't matter because I'm not a day trader.
Yeah.
You know, I'm sort of picking 2, 3, 4 month moves. So what happens intraday? Well, I watch and fret. It doesn't affect my P&L so much over time. So, but I do hear what you're saying. So, you talk a lot, as pretty much, I think, anybody who is approaching this market from a realistic point of view, a lot about things like process, things like discipline, things like risk management, right?
Yeah.
Which I think you would agree are really the most important parts of this whole thing over time.
Absolutely.
So a lot of people, including me, talk about that a lot. Okay. Risk management. Okay. But on a more practical level, what does that mean? Like, I understand you got to stop out of losing trades. Okay, great. But I could stop out of every single trade I put on as a losing trade. And that's not going to help me very much either, right? Might say, hey, I have great risk management. I stop out of all these trades. But if I stop out of every single trade at a loss, then that's not going to help me either. So can you maybe try to expand on your thoughts on that risk management? What does it mean?
I think a great way to introduce somebody to the power of risk management is to introduce the concept of expectancy and give them a very simple spreadsheet. And this is something I've done with members in my program, and just show them how you can make money on a system that wins 20% of the time. All right. Most people, they get into this business thinking my number one job as a trader is to be right. All right. I've got to win every trade. No. You can make a lot of money if you lose 80% of the time. Now, that doesn't suit me personally. I don't think that's a fun way to make money. I think would be quite stressful. But you can make money on a coin flip entry system where you win 50% and you lose 50%, provided you have a system in place that enables you to stick with your winners and cut your losers. And I would just say, if you assume that you've got a random entry, you try and take profit at 50%. But if you're doing that, make sure you're cutting losses at 25%. And if you do that, even with a random 50-50 win-loss kind of system, you will make money. And by teaching somebody the concept of expectancy, they can see just how powerful risk management is. And, you know, when I look at my trading performance this year, 2023, my most profitable month was August. And August, I had a 40% win ratio. All right. And that was my lowest win ratio for the year, month by month. But I was up 13.4% that month. I've had other months where I've had a 75% win ratio and my NLV is only increased by, 5.5%. So having that advantageous risk or reward to risk ratio really can swing things in your favor.
Yeah, for sure. I clearly preach that. That's the only thing that matters for me. Is you have to be flipping coins and be getting paid, 3 for heads and paying out 1 for tails.
Good
And
analogy.
and then you want to, obviously, if you can get that, then you want to flip as many coins as possible. Get paid 3, lose 1, get paid 3, lose 1. That's what I always say. That's what trading is, and I think you're right that that's what people least understand about this game. They want it to be about getting the market right or wrong.
Yeah.
And I try to tell people that you're not going to do that over time, okay? Because you're predicting the future. So the chances of predicting the future more often than not are pretty much zero. So you got to get that out of your mind. Go ahead.
So yeah, I agree. I always say to people, your number one job as a trader, it's not to be right. It's to stop a small loss from becoming a big loss, because it's big losses that will demoralize you psychologically, but they'll also do enormous financial damage to your account.
For sure.
And trying to trade your way out of a hole, almost impossible.
No, it's hell. It's hell. Yeah. Again, I've said it before. If there's one thing that I can give myself credit for doing well, it's taking losses. That's it. My ability to predict the future is clearly no better than any other person on earth. I think maybe what I have learned after 35 years, and therefore maybe do better than most, is take losses. That's it. That's my whole thing, right? That's why I'm still alive here, right?
Yep.
So yeah, I agree with that 100%. Can we get into specific examples? Like, do you have a process that you follow, one process or more than one process, or
around risk management?
No, just around trading. And then maybe if we talk about that, then maybe you could give us the exact examples of how you handle risk management within that process.
Yeah, sure. So I'm a trend follower at heart, because trend following it's easy, it's intuitive. You're following the path of least resistance. I find it easier to allow your winners to run if you're following the trend, because if you pick the right spot in the trend to join the trend, things can move in your favor quite quickly, and you tend to know fairly quickly if you're wrong. But in a choppy market like we've had for the last 3 or 4 months, counter trend trading, I find, is a really, really powerful tool to have in the arsenal as well. And this is where you are trying to pick high probability tops and bottoms. You're fading the medium term trend with the idea that something is, it's going to form a bottom or form a top. And one thing I love about trading options is I don't have to trade directionally. You can sell a credit spread, and normally I'll do a counter trend trade by selling a credit spread. So if I think a counter is bottomed and I'm taking a counter trend long trade, I'll usually sell a put credit spread, because I don't actually need the stock to rise. I just need it to stop falling. I just need it to not fall much further. So that's very handy.
But let me just stop you there if I could.
Yeah, sure.
If I think that a stock is about to turn, is what you just said, right?
Yeah.
So it's been going down and you think that it's going to stop going down.
Yes.
What is making you think that? Is this just a discretionary thing, or are you looking at systematic things, or is it a combination, or what's making you think that a market is going to stop, a stock or whatever you're trading is going to stop?
No, good question. What I'm really looking for is failed breakdowns. I'm looking for a stock that makes a new low and then reverses back up. And what I'm looking for is trap shorts, basically.
So it's similar in certain thought processes to what I'm trying to do, which is it's a positioning thing, really, is what that is. You've got all these trap shorts, and and now they're screwed. We had one of the most unbelievable trap long trades I've seen in a while in gold. I'm sure you saw the other day. It was
Yeah.
just an amazing move. Made that new high, reversed, and like moved $100 in a day.
I mean, the reversal was even more stunning.
It was pretty breathtaking. Yeah. So I say, so you're looking for, it makes a new low. I don't know what time period you're talking about. What do you generally trade in? What kind of time periods?
So I anchor nearly all of my trades to the daily chart. Sometimes I'll look at a 195-minute chart. I'll look at lower time frames and higher time frames for trend confirmation, but probably 90% of my trades are anchored to the daily chart.
Okay, so you're not day trading these things.
No.
These are sort of swing, more longer term trades.
Swing. It's my average holding period would be anything from 2 to 3 days to 2 to 3 weeks.
Right. It's a new word that I've learned recently as I've gotten into this whole thing and started to come across other traders who I never really was involved with talking to other people very much. It's my new word, swing. Swing trading. People say it to me all the time now. Are you a swing trader? I'm like, I don't really know what that is, but seems like that's more of a 2-3 day thing. So that's not what I am, as it turns out. But so you're doing sort of that swing thing. Thing makes a new low on a daily chart, then comes off that low, and now you've got all these trap shorts. So you're going to front run them getting stopped out of those shorts, essentially.
Exactly. Yeah.
Yeah, which is great to me because it means that without knowing much about your history, it would imply to me that you have been on the wrong side of that and you've seen what it's like to lose. I mean, that's really how I develop my whole process, right? Is if I'm on the wrong side of these trades all the time, well, then maybe flipping it around, I could be on the right side of them, right?
Exactly.
So a lot of people get caught on these false breakouts because a lot of people like to trade breakouts and a lot of people like to trade trends. And yeah, they get caught on these false breakouts and suddenly they're going to get stopped out. So why not recognize when that's going to happen to them, take the other side and make money off of them getting stopped out rather than be on the bad side of it, which we've all been on.
Exactly. So that's my bread and butter kind of counter trend setup.
I like it. Otherwise, you're riding a trend.
Otherwise, I'm riding a trend. So trends, trend following works great in a market like, 2020 from April onwards, or 2021 was just a trend follower's paradise in the equity market. Bear markets are always tougher because the bear market rallies are so severe, right? If you're just trying to short every top, you're going to get cleaned out. So when you're in a bear market like 2022, you've really got to be able to trade both sides of the market. People think trading a bear market is just the mirror image of what you do in a bull market, and it isn't. They've got quite a different personality.
Certainly in the equity markets, to say the least. Yeah.
Yeah. And then, we had sort of, that period, March to July was a great trend. You just buy every dip. And then July to September was kind of choppy. That's where counter trend trading really proved its mettle to me again.
So, yes, trading in a bull market is different, especially in the equity market, is much, much different than trading in a bear market. I think we can all agree with that. The question is, of course, how do we determine when we're in a bull market or when we're in a bear market?
Well, I've got a horribly simplistic way of doing it. And really, I just look at the 200-day moving average. I call the 200-day moving average the Jekyll and Hyde switch, because really, you look at any long-term chart of an equity index, you can see that personality shift. As soon as you start getting closes below the 200-day, and as soon as that 200-day starts pointing downwards, things just become a little bit unhinged. You get big moves to the downside, but also huge rallies, huge moves to the upside. It just becomes a lot more volatile. The markets that are trading under their 200-day moving average, they tend to have a faster, scarier feel to them. News headlines are generally pretty awful. You generally know when you're in a bear market. Especially if you're trading one, it does feel quite different.
Okay, so that's a nice simplistic way to look at it, which I always believe, as you said in the beginning, simple is better. People like to complicate this stuff so much
Yeah.
sometimes, and it's hard enough as it is, right? You're dealing with what is essentially a random data series and trying to predict a future that you can't predict. And so you can put 1,000 things on top of that to make it complicated. It's not going to do anything, I think. So 200-day moving average, if it's above it, it's a bull market. If it's below it, it's a bear market. And therefore approach it as a bull market when it's above and approach it as a bear market when it's below.
Pretty much in a nutshell. Yeah.
So what do we do about times like recently, where I don't know because I don't look at moving averages a lot, but I would assume that coming into the first week of November, the S&P was below the 200-day moving average.
Mm. Look, I think November was one of the tougher months to trade because the market just went up in a straight line. There was no real opportunity there was no high probability moment in time to kind of join that train. You just kind of had to, you know, close your eyes and pinch your nose and buy it if that was your thing. November's actually been my worst month this year. I found it a tough month to trade.
It sucks. Sorry to hear
That's all right. I'm having a great year. You know, I'm allowed to have a bad month.
No, I hear you. It's just, I just always sympathize with somebody, because I have them all the time, right? And then bad months always suck.
Yeah.
Um, but it's the total right attitude. It happens. I'm having a good year, and it happens. That makes sense. But yeah, so November was an out of nowhere situation for sure. Um, so all these things become strictly price. I mean, tell me if I'm wrong, but strictly price things to you, like trend is a price thing, right?
Yeah, price is really what I focus on. I mean, I look at things like the put call ratio. You know, I look at statistics like a Z-score. You know, I will look at kind of sentiment indicators and overlays and that type of thing. But price is key for me, definitely.
Right, because that's what trend is. So it's a price thing. So you're either doing these counter trend trades, as we spoke about, or you're doing a trend trade. And
Mm-hmm.
are you willing to tell us a little bit more about how you approach the trend side of things? Is it based on moving average crossovers, or is it based on making a relative new high, or is that?
Yeah, look, it's more about identifying a strong trend and then identifying a high probability moment in time to join that trend. So to find the strong trend, I look for what I call rainbow logic. So I use a series of moving averages. I use an 8-day EMA, a 21, a 34-day EMA, and then I use a 50-day SMA, a 100, and a 200 SMA. And I color code them. So they're red, orange, yellow, green, blue, violet. So they look like a rainbow on my chart. So when I see a rainbow, I know I've got a strong trend in place. And when I see an upside down rainbow, I know I've got a strong downtrend. So in a split second, I know whether I want to be trading from the long side or the short side. So that maps out the trend. And then it's a case of, well, how likely is this trend to continue? And then I use ADX. It's just as a very simple filter. The 13-period ADX is 20 or above. That's a trend that's likely to continue.
Sorry, what's ADX?
Average directional index, I think it stands for. Yeah.
Okay.
It's just a measure of trend strength. And then really all I'm looking for is a pullback to, say, the 21 EMA or the 34 EMA or maybe even the 50 SMA. But I like stocks to hold the 50-day simple moving average. Once they get below that, the trend is weakened enough that I'm happy to just stand aside and leave it to someone else. I always say, if you're trying to force a trade, if you're poring over a chart for 10 minutes, figuring out whether you should take the trade or not, don't take it. I think you've probably already spent, way too long on it. The trades should be fairly obvious. And if they're not, then I just put them in the too hard basket. And I don't trade every single day. There are some days where I might peruse a dozen stocks and all of them are, there's they're just not quite right. And I really prefer to take a setup that ticks every single box than try and force something where, only 7 out of the 10 boxes are ticked.
Oh, I think that's such an important concept. The concept of not trading, which I know are things that I've seen you speak about as well, which really, like I said, drew me to you, because a lot of the things you speak about are things that many people don't speak about, even though they should be super obvious. And not taking a trade is one of the most important things, I believe. I try to walk away from trades all the time if they're not exactly what I want, and clearly sometimes I'll miss something, but over time, I believe it will be beneficial to me. I think that's just such an important concept that people have. And look, I have a hard time with it too. I'm totally slave 95% to my process, right? And I have so many ways to ensure that I follow that process, going straight down to what my business is. That's the best thing that I have in terms of my process is I have sold to my clients the idea that what this process does is provide a negatively correlated return stream to what you guys are doing, right? To trend following, to most of the things that are going to be in their portfolio. And that is why they give me money to manage, right? So because of that, that's what I have to provide them, right? So that keeps me slave to my process, because I know my process will provide them that, right? But even within that, just like every human being, it's a struggle, it's a struggle. But again, to your point, so important. I had from September through now, I've had 2 trades. I got my monthly statement the other day.
Right.
I had one trade on my monthly statement.
Wow. Okay.
It's been extremely, it's rare for that to happen. And in fact, I don't think that's ever happened. Certainly I know for a fact, since I've come back, I retired for a year and a half or so, but since I've come back, it's been 7 years. That hasn't happened in 7 years. I know that for a fact.
Oh, right. Okay. So that's pretty rare.
It's very rare.
Yeah.
And so, and listen, it worked. You know what I mean? For most of it was just one trade, right? And it worked, and it put up a nice return for me, and that's all great. But it's so hard to sit here every day
Yeah.
and not put a trade on. The discipline of that is so very, very hard, So anyway, back to your point, which was that if it's not your rainbow says the trend is up, you get a pullback to a moving average that you like, so you go with the trend. You're buying a pullback in the trend. That's
right. Yeah.
That's sort of your discipline for entry, is what I'm hearing. And if that trend then fails, goes through the 50-day moving average or something like that, right? And I assume that's where you're just cutting out of it and saying, okay.
Yeah, so I trade options almost exclusively, and so let's say I've bought a call option or a call debit spread, I'm looking for a directional bullish move. I have what I call my OMG stop loss level, as if I lose 50% in premium. So if I pay $10 in premium and it drops to 5, I cut the position no matter what. But I'm trying to get out of positions well before that happens. All right. And I can tell you a story about that in a minute. But what I'm looking for is any doubt that I've got over that position, and I'm out of the position. All right. I always say I need 3 or 4 reasons to get into a trade. I only need 1 reason to get out. And it could be a swing low being taken out. It could be a close below the 50-day moving average. It could be the 8 EMA crossing out of the 21 EMA. These are all early warning signals that the trend, or what I thought was going to happen, is considerably less likely. And if I stay in that position, I'm hoping, rather than working a probabilistic edge, right?
That's a
two very
problem.
different things. Yeah.
Yeah.
So I would
Bad
much
word.
rather,
Bad
yeah,
word.
oh yeah, 4-letter word for sure. Yeah, I'd much rather be out of a position wishing I was in than in a position wishing I was out. And the thing is, transaction costs these days are zero or negligible. If I still like the position after I get out, I can always get back in again.
It's a fact. So basically, you're getting out, you're stopping out. You have a defined stop out at 50% of whatever the premium thing, or whatever a price thing that's not working. You're out. Otherwise, you're riding it for the most part, right? And trying to
I
maximize the gain.
I used to take the approach of kind of, right, there's my profit target, there's my stop loss, and I'm done, and then I'll just wait and see what gets hit. But I found that by being far more proactive and cutting positions well before my stop loss gets hit, that is the low hanging fruit in terms of increasing your NLV month to month and year to year. Trying to extract another 15 or 20% of upside out of a trade is actually quite hard to do. But saving yourself 15 or 20% of downside, that's actually really easy to do. So cutting losses sooner and earlier, I find is actually the easiest way to improve your results.
Oh, such a good point. Such a good point, man, that people don't think about, that they're trying to maximize their gains and they don't realize that they can maximize their gains by cutting their losses better.
Just making the losses smaller relative to the gains. Yeah. But
No,
trying to
I
really,
love it. I love it.
yeah,
That's
extract
an
all the
important-
juice out of your gains is really tough.
It is. But again, if your losses are smaller, then you don't have to, I mean, that's just a fact. It's just a mathematical fact, I get ripped on a lot because my drawdowns are so small. And so people tell me I should lever up more. Because if my drawdowns are so small, then my gains can be obviously that much bigger. And I don't agree with that concept, but because people forget the math and the psychology of it all, right?
Oh,
I'm
right.
You know what I mean? Just because I draw down 3% and make 10 doesn't mean that I'm going to draw down 9% and make 30, because it's going to get in my head. You know what I mean?
Yeah, big time.
And so, I suggest to clients that they can lever me up if that's what they want to do without me even knowing. But I'm sort of in a zone where I'm comfortable with my drawdown. So, but that's the key, like I say, to my game is keeping those drawdowns small. It helps your overall gain clearly because you're not making back losses all the time, right? If you have I had a 3-month or almost a 4-month drawdown this year, and the total drawdown ended up being like 60 basis points. So like, one day or 1 week, right? And I can make that back right now.
Yeah.
Sitting through 4 months of nothing and nothing and nothing, you know what I mean? Just whipping around and making and losing and slowly kind of sucks when you're in the middle of it. But when you come out of it in a week, it's awesome. And I think you'll agree, this is what it gets to a bigger concept of the time frame in which you're thinking, right? I think a lot of people are thinking in the time frame of today. How am I going to make money today? And the time frame you need to be thinking about is, to me, 10 years. How am I going to make good risk-adjusted returns over 10 years? Which means this particular trade, and I know you've spoken about this, but this particular trade really means nothing. What happens today really means nothing, right?
Yeah, that's such an important point too.
Yeah.
Yeah, it's just treating trading like a business, like your job. I mean, if you're sitting in a normal desk job, what you do today is really that important. It's the work that you achieve over the the next quarter, the next year, the next 5 years, whatever. Trading's no different.
It's a fact, and I think this is what people also miss. For some reason, people believe trading is something else, different than anything else in life, and it's not. It's just another thing in life that takes all the good habits that anything else takes, right? So we're getting in on the trend. We're getting in on the pullback of the trend. We're getting out on the failure of the trend, or we're stopping out on the failure of the trend. And then where are we taking profits? Do you have a process for that? Or is this more feel, or is this more
No,
process oriented?
it is process. I mean, what I'm really looking for is typically I'm looking for a move. I'm looking for price to get from, I'm trying to enter near the mean. And the mean for my purposes is the 21-day exponential moving average. And I'm looking to exit when price gets extended away from the mean. So typically I'll look at the stock's average true range, ATR, and I'm looking to exit at, say, 2 to 2.5 ATRs away from the mean. And
the mean is measured by a moving average.
Yeah, exactly. So I'm just looking for price getting extended away from the mean at a point where a reversion back to the mean becomes statistically more likely. I'll also look at, I'll look at historical support and resistance. I'll look at, Fibonacci extension levels. All of this will form a kind of composite view of where I expect price to go and where I'm likely to start taking profits. And of course, if anything unexpected happens, then I'm liable to cut the position sooner rather than later.
So a lot of this is sort of a combination, it sounds like, of a process. Within that process, there's also, it seems like, a little bit of a feel to it as well, a little bit of discretionary feel to it as well.
There is definitely discretion to it. Yeah, it's not systematic what I do. I mean, it's the systems provide guidelines. All right, so I've got kind of targets in mind. But if we fail before we get there, I'm not going to stubbornly hang on and expect that target to be fulfilled. I'll walk away with a smaller loss than what I'd hoped for, but it's better than hanging on and letting a small profit become a small loss.
And how do you handle position sizing? Is it sort of every position that you put on, you have the same risk to your portfolio, or?
Yeah. I mean, I joke that conviction is for criminals, and sell side salespeople. But I mean, the thing is, if I never go all in, I never load up on a position. All right, because if I do that, it implies I know that this setup is better than all the other setups, and how would I ever know that?
And why wouldn't you just do those if that was the case, right? If you knew that a certain setup was better than others, then you would only focus on those.
Well, let me ask you, Jason, how many trades do you put on expecting that there'll be a loser?
All of them.
Oh, really?
Yes.
Okay. No, I mean, I expect every trade I put on is going to be a winner. I know they won't be, but I never put a trade on that I think is going to be a loser.
Yeah.
Otherwise, I wouldn't put it on. All right. But
no, clearly that's clearly. Yeah, I say that as a joke, although I don't really say it as a joke. I don't expect them. Well, in a way, I do expect them to be a loser. I like to be surprised, I guess, is my point, right? So I assume she's going to be a loser, and if she's a winner, then I'm surprised and I feel happy. But anyway, go ahead.
So my basic approach is I'll take 2.5% of my NLV risk on a debit position, so a position I've got to pay to put on, and I'll usually risk 5% of my NLV on a credit position, so like a credit spread, any position where I get paid income up front to put it on.
Okay. So you're risking about 2.5% on certain trades, 2.5% of your portfolio, I think, on certain trades.
Yeah, that's right.
And 5% of your portfolio on certain other trades.
Yeah, that's right.
And how has that made your return streams look, if I can ask? What kind of vol does your return streams have? If you want to,
I target a return of 5% per month. All right, and
wow,
nearly every month I make that, and some months I do, substantially better than that. But what I used to do, but before 2020, all right, I was risking 5% on every trade, sometimes even more than that. And then when things got kind of volatile during COVID, I cut my risk right back, and I found that even cutting my position size in half, I can still make my returns. And so I just kind of left the position size there. I always thought, when things go back to normal, in air quotes, I'll increase my position size again back to what it was pre-COVID. But I found that I just never needed to do that. I can still generate my target monthly returns with what I consider to be a fairly small position size. Some people have a fit. Some people think, oh, you're mad if you risk more than 0.5 to 1% of your position on a trade. But I think so long as you manage them carefully and you've got some asymmetry, you're selling yourself short if you don't take a bit of risk.
Yeah, I'm definitely doing that. Everyone keeps telling me I'm doing that, but whatever. So are you telling me that you're putting up 50% a year on your account?
Yeah.
That's awesome. How long have you been doing that for?
Well, I've been doing that since 2017.
17, 18, 19, 20, 21, 22, 23. So for 7 years, you've averaged 50% a year on your.
Well, more than that. I mean, I was up 363% in 2020.
Geez, that's awesome. And what kind of drawdown does that entail, if I can ask?
I have a risk management rule that if my portfolio draws down to 15% below a high watermark, I sell everything and go to cash. And
Okay, you have to get in again at some point. So
yeah, but I haven't had one of those since October 2018.
So you're putting up over 50% a year return without a 15% drawdown.
Yeah.
That's awesome. And this is all your PA, I guess. Are you managing outside money or
No, I don't. I don't manage money for other people. I mean, I had a friend and I had a very serious look at setting up a fund back in 2018. We met all of the prime brokers in town in Singapore, and we met lawyers and custodians, and we really kind of did a lot of due diligence on it. And I just realized that it was going to take me away from what I really love, which is trading and teaching. I love teaching people how to trade. And B, it was going to be very expensive to set up, and it was going to be a very, very lean 3 years while we, establish a track and do all of that. So, and the other thing was I left the corporate world with a realization that I'd spent my entire corporate career helping people who were already incredibly wealthy either stay that way or get even wealthier. And I wanted to put the skill set that I'd developed to use to, help people who could really benefit from the skills and knowledge that I've developed. And if I set up a fund, I'd only be helping the super wealthy again.
Amen to that. So on that note, where can these people find you so that you can show them how to do these? In fact, where can I find you so I can make 50% a year? But even besides that, where can people find you? I assume it's a taooftrading.com or something like that.
Yeah, that's right. So yeah, the homepage is taooftrading.com. That's taooftrading.com. I've got a book on Amazon by the same name. Costs $9 for the Kindle version. And yeah, I'm on Twitter, Simon Ree, Simon_REE. I'm on LinkedIn as well. Same name, Simon Ree.
So they can go there, and you offer, I assume, some kind of either mentoring service or some courses or.
Yeah, so we've got an online course. The flagship program is called Options Academy Elevate, which will really teach you everything that you need to get started. All right, everything from technical analysis to setups to what is an option to risk management and trading psychology. All right, getting your mindset right. It'll teach you mechanics like debit spreads and diagonal spreads, and what is delta, what is theta. And then we offer a coaching and mentoring service called Options Academy Accelerate, where for a monthly subscription, people get to see what trades I'm placing each day, how I'm managing them, the winners, the losers, where I'm taking profit, where I'm cutting losses. We offer a bi-weekly webinar. So yeah, that's for people who are yeah, as the name implies, really looking to accelerate their development.
Cool. Well, I would encourage people to check that out. Is there anything else you could tell us? Maybe I'm just curious because you name your thing the Tao of Trading. I think that's a function of you having a deep-rooted belief system or understanding of sort of Eastern philosophy, which from what I can tell comes from, and maybe I'm wrong about all this, but comes from your involvement with the martial arts. It sounds like to me,
That's
right?
right. So in addition to being a trader, I'm also a Jeet Kune Do instructor. And so Jeet Kune Do is the martial art that Bruce Lee developed. And Bruce Lee wrote a wonderful book, one of my favorite books, called The Tao of Jeet Kune Do. So really the title of my book is an homage to Bruce Lee and his work.
So yeah, I had a big, I would say, change in my life when I started to get into Buddhism, and spent a long time at a Buddhist monastery, and it really sort of changed me completely, I would say.
Yeah, I read about that in your interview with Jack Schwager.
Yeah. So without spending too much time on it, I guess, but before we wrap up, I do have to ask you, can you just give us some lessons on that and how that has helped your trading and how we should approach is it be like water or, something to that effect that will help us as people and as traders?
Yeah, I mean, be water is, I mean, it sounds really, really simple, but it's actually incredibly deep and it can be interpreted so many ways. But I think, yeah, just being open-minded, fluid, adaptable, don't be rigid, don't be locked in. Yeah, just always be able to adapt and change and the way water does. I think the parallels between martial arts and trading are numerous, but probably one of the clearest parallels I can think of is, in martial arts, you learn to punch, you learn to kick, you learn to block, you learn to grapple. But what happens when you take a hit? Does the motor die? Do you crumple in a heap? Do you lose confidence? Do you give up? And look, it's the same in trading. You learn how to buy, you learn how to enter, you learn how to exit, you learn how to manage risk, you learn how to read charts. But what happens when you take a hit? Is that hit's going to come, and multiple hits are going to come along the way. And how do you respond to that? Are you going to crumple? Are you going to give up? Are you going to lose confidence? Or are you going to pick yourself back up and trust the process?
Beautiful. It's so damn true in life and in everything and in trading, but so damn true. Oh, it's so easy to trade. You just open a brokerage account and make a trade. And there's maybe, let's call it a 50-50 chance that your trade's going to work, right? And anybody can do that, you know? But how do you respond to the downside? I mean, it's just, to me, that's the test of a human being across the board, right? And getting to how trading is no different than anything else in life. I think it's just so damn true. I love that. I love that. I've had to pull myself up by my bootstraps on numerous occasions in this life.
Mm-hmm.
And that's really kind of made all the difference. And it's not like I didn't go through the period where I, got in bed and got under the covers and pulled the covers over my head and never wanted to get up again, but at the end of the day, you got to stop crying and get back on your feet, be it trading, be it anything. And even on the micro basis of be it an individual trade, right? Like you said, and like we know, you're going to have losing trades. And as disciplined as you stay, there's going to be times where that losing trade is even bigger than you expected it to be for whatever reason. Liquidity dries up, something happens,
Mm-hmm.
hesitate for half a second on your stop, and all of a sudden the thing collapse, who knows what, right?
Yeah.
But you got to come back, man. You know what I mean? You got to come back.
Right.
So I love that. I appreciate that. I just saw that movie, Once Upon a Time in Hollywood. One of the
Oh, great movie. Yeah.
one of the funniest Bruce Lee scenes, and obviously it's not really him, but to me, just one of the funniest things of Bruce Lee that I've ever seen. I just was on last night. I love watching that scene. Anyway, Simon, it's been a great pleasure to hear from you. I hope that people will visit your site, because it sounds like you have a lot of knowledge, and it sounds like you're having a lot of success. And if there's anything else you'd like to say, please say it. Otherwise, we can say goodbye for now. And I really wish you the best. You sound like, even though you're from Australia?
I'm from Australia, based in Singapore, but I trade the US market. Yeah.
Even though you're from Australia, you seem like a really good guy, and it's been great having you on. So.
It's been a real pleasure talking to you, Jason. Lovely to meet you, and love your work. And yeah, just keep doing what you're doing, man.
Awesome. Thanks, man.
Thank you.
Subscribe to Crowded Market Report by Jason Shapiro.